In this video, we take a closer look at risk and ways to reduce it from a theoretical perspective. Risk aversion is the tendency of people to refuse to accept fair gambles. People, and by extension many organizations, tend to be risk averse. We saw in an earlier video that diminishing marginal utility explains why people tend to be risk averse. Here we review diminishing marginal utility. You see, as income increases, utility rises, but it rises at a diminishing rate. Imagine you are risk averse, have an income of $35,000, and are offered the opportunity to play a game that returns $5,000 if you win and costs you $5,000 if you lose. Your certain income of $35,000 yields a utility of U3 for sure. The gamble means your income could be $30,000 or $40,000. But since the outcome is uncertain and there is a 50-50 chance of $30,000 or $40,000, the expected value is $35,000, shown as the red dot. Notice the utility of the expected value, or the expected utility of $35,000, is only U2. This is less than U3. So you would not take the gamble because you have more utility with a sure U3 than an uncertain U2. Now consider a gamble with a 50-50 chance of winning $15,000. You could end up with $20,000 or $50,000. But the uncertainty leads you to an expected value of $35,000 again. This time the utility is even less than a gamble of $5,000 with an expected value of $35,000. Notice the red dot this time. You would not take this fair gamble either because you can have a certain utility of U3 with a certain income of $35,000. An uncertain income of either $20,000 or $50,000 produces utility of only U1. Psychologically, risk-averse people weigh losses more heavily than they weigh gains. The $15,000 fair gamble described here has an expected value of 0. Look at the calculation. Plus 15,000 weighted by its probability of 0.5 added to minus 15,000 weighted by its probability of 0.5 yields an expected value of 0. But when we weigh losses more heavily, it is as if the gamble works a little bit differently, as shown here in the second equation. We have plus $15,000 weighted by its probability 0.5, and we have twice minus 15,000 weighted by its probability of 0.5. The 2 there arbitrarily indicates how losses are more heavily weighted than gains. This results in a gamble that functions as if it had an expected value of minus $15,000, and that is why people shy away from it. So a fair gamble feels unwise. Many risk-averse people are willing to pay to avoid risk like this. Let's return to the $5,000 gamble. Suppose you were required to take this gamble. What would you be willing to pay to avoid the risk? According to our figure here, an expected income of $35,000 has less utility at U2 than a certain income of $35,000 at U3. Now we shift our focus to the values U3 and U2. U3 occurs when income is $35,000. U2 occurs when income is $33,000. Notice we are just looking at the utility function now and not the red line and the red dot. So $33,000 for sure provides U2, and $35,000 for sure provides U3. $33,000 for sure provides the same utility as an expected income of $35,000. $33,000 is called the certainty equivalent. That is, it's the guaranteed amount of cash that would yield the same exact expected utility as a given risky asset. A rational person would be willing to pay the starting position, $35,000, less the certainty equivalent of the risky asset, $33,000, to avoid the risk. So if we can pay $1,000 to get rid of the gamble, we'd have $34,000 for sure, and that provides more utility than $33,000 for sure, and so we would be willing to pay that. If we paid $2,000, we'd have $33,000 for sure, and that provides the same utility we would have with the gamble. If we had to pay more than $2,000 to avoid the gamble, our utility would drop below U2, and we'd be better off accepting the gamble. Notice, by the way, that the shape of the utility curve tells us about the person's degree of risk aversion. The steeper the curve, the more risk-averse the person. A straight line identifies a risk-neutral person who would always be willing to accept a fair gamble, because the risk means nothing to such a person. For small gambles, a risk-averse person may be nearly neutral. People and organizations have several options for reducing risk and the uncertainty that gives rise to it. We will consider 4 methods: insurance, diversification, flexibility, and information. Let us look at reducing risk through insurance. We begin by considering what a forced gamble or risk might look like. It could come from living in a floodplain or in a crime-prone area, perhaps from living in a rural area beyond the reach of the local fire department. Or it could come in the form of medical bills. Suppose you make $35,000 and have a 50-50 chance of a $15,000 medical bill. Notice the expected value is different now. It's 0.5 times 20,000 plus 0.5 times 35,000, yielding an expected value of $27,500 as shown in the figure. The utility of an expected income of $27,500 is U1. Now let's consider the case of fair insurance using what you just learned about certainty equivalence. With fair insurance, the premium is equal to the expected value of the loss. In this case, the premium would be $35,000 minus $27,500, or $7,500. A policy that costs $7,500 would move the person from a certain income of $35,000, shown at point A, to a certain income of $27,500, shown as the blue point on the utility curve. Thus, the insurance policy would increase the person's utility from U1 to a certain utility of U2. The problem with this situation, however, is that an insurance company cannot make money by selling fair insurance. The fair amount would just enable them to cover insurance claims. They must charge more than that to finance their business operations. So how much would a person be willing to pay for insurance? With no insurance, expected utility is U1. This person can get a certain utility of U1 with $24,000 in income. So the maximum amount they would pay to obtain U1 in utility is $35,000 less $24,000, or a maximum of $11,000. In general, risk-averse people will buy insurance against risky outcomes as long as the premiums do not exceed the fair premium by too much. In our example, the fair premium was $7,500, and we learned this person would pay up to $11,000 for insurance. Not all risks are insurable. Some risks may be unique or difficult to evaluate, as was the case with flood insurance when that program first started. The problems of adverse selection and moral hazard can also interfere with insurance markets. Risk can be reduced through diversification. Suppose you have $35,000 and can invest $15,000 in Company A, Company B, or both. Let one share of stock cost $1, and let there be a 50-50 chance the stock will double in price to $2 or it will fall to $0 by the end of the year. Imagine putting all $15,000 into one firm. Then at the end of the year, you will have either $20,000 or $50,000, and the expected value is $35,000. The investment is a fair gamble, as we've seen before. Now consider a diversification strategy where you put $7,500 into A and $7,500 into B. Then what does the outcome look like? Consider the table shown here. If both companies perform poorly, you will have $20,000. If both perform well, you will have $50,000. Because there are 4 outcomes now, each has a 25% chance of occurring. If one company does well, it produces $15,000, and if one does poorly, it loses $15,000, leaving you at $35,000. Like before, your expected value is $35,000, and that is computed as 0.25 times 20,000 plus 0.5 times 35,000 plus 0.25 times 50,000. But there's a difference this time. Though the expected values are the same in both cases, you are less likely to end up with the extreme payoffs when you use diversification. Here we use our theoretical model to understand what's happening when we diversify. Diversification spreads the risk around and avoids putting all your eggs in one basket. Diversification can raise the expected utility above the expected utility associated with putting all one's money into a single stock. So we return to our Company A and Company B choice and add the assumption that the prospects of the two companies are unrelated to one another. In other words, A and B stocks may move in opposite or the same directions. If you invest in only one company, you end up at the red point with U1 as your expected utility. Let's consider a diversified strategy where you buy 7,500 shares of stock in each company. There are 4 possible outcomes as seen in the previous slide, and they are all equally likely. Your goal is to understand how the reduction in risk results in a utility gain to diversification, and that's going to require a little ingenuity here. Point C represents the average utility when Company B does poorly. That is, it's the average utility between $20,000 and $35,000. Point D represents the average utility when Company B does well. That is, it's the average utility between $35,000 and $50,000. Now we take the average of points C and D and derive point E, which represents an expected utility of U2, which is higher than U1. thus proving this individual has gained utility from diversification. And this individual has reduced risk through diversification. Diversification describes the benefit of investing in mutual funds that invest in many kinds of stocks, and it also explains why wealth is held in a variety of assets like stocks, bonds, savings accounts, cash, real estate, art, precious metals, and so on. The risk reduction of diversification increases utility to individuals and income to companies. Diversification works when you can allocate small amounts of some large quantity among a number of different choices, like diversifying a financial fund among a number of assets. But what if decisions are all or nothing? Then flexibility may help. It's good to have options so a decision maker is not tied to one course of action. Flexibility allows a person to adjust the initial decision depending on how the uncertain future unfolds. Flexibility becomes more valuable the more uncertain the future looks. It keeps the decision maker from becoming tied to one course of action and provides a number of options instead. Consider a simple example. You are choosing a coat for a camping trip. You can buy one of 3 coats. The table here shows you the utility you expect to derive from each coat. Higher numbers mean more utility. A parka is best if the weather is bitter cold. It is less useful if the weather is mild. The expected utility of the coat, given weather outcomes are 50-50, is 75. The utility of the windbreaker is just the reverse. Its utility is also 75. The 2-in-1 coat has 2 layers. Together they provide the warmth of the parka. Unzipped, they provide the protection of a windbreaker. If the 3 coats cost the same, the 2-in-1 is best because it offers more options and its utility reflects that at 100 compared to 75 for the other coats. A camper might well be willing to pay more for the options the 2-in-1 coat offers. Options reduce the risk of an uncertain future. Our simple example offers an example of a real option, that is, an option arising outside a financial setting. An option contract is a financial contract offering the right, not the obligation, to buy or sell an asset over a specified period of time. For example, you might purchase the option to buy a share of Google stock at $700. How much you might pay for that option depends on the uncertainty and the attributes of the option. If Google stock always sells for $700, the option is worth less than if its price fluctuates. The more it fluctuates, the more valuable the option. If Google price rises over $1,000, the option is quite valuable. Information can also reduce risk. Consider our code example one more time. Suppose we have new information, a better forecast of the weather. Now we know that bitter cold is even colder than we thought, thus increasing the value of the parka and reducing its utility in mild weather. Likewise, mild weather is more extreme than you thought, thus producing the opposite effect. The 2-in-1 coat provided a gain of 25 units of utility, or utils, under the prior conditions. Now, with no change in the price of any coat, we now know the 2-in-1 with an expected utility of 150 provides an increase in expected utility from 25 to 75. To see that, we use 1/2 times 150 plus 1/2 times 0, and that yields a utility of 75 compared to the new utility of 150. Thus, information about the weather has increased the value of the option and increased expected utility, thus reducing risk.